Welcome back to the Legacy Radio Network. I'm your host, Dennis Tubbergen. This is the Everything Financial Radio Show. We're glad you're with us today. We are chatting with Dr. A. Gary Shilling, who is the author of the book, The Age of Deleveraging, Investment Strategies for a Decade of Slow Growth and Deflation. Gary, in your newsletter, you made a point that I found very interesting. You stated that, and we talked about in the last segment, that it's likely the U.S. economy is entering a recession, and if that is the case, it'll be the first consumer-precipitated downturn since World War II. All others have been initiated by the Federal Reserve. Can you explain?
Yeah, that's right. The normal recession is precipitated by the Fed. The central bank is worried about an overheating economy. They raise interest rates. That kills interest rate-sensitive sectors, particularly housing. Results in layoffs, and then the economy slows, inventories get built because producers, wholesalers, retailers don't realize immediately the downturn is more than just a squiggle, and then this whole process slows incomes, consumers start to get worried, you get to the peak of the economy about then, capital spending is being cut back as capacity utilization rises, and the recession really gets underway, and a lot of that recession is getting rid of excess inventories, but also the weakness in housing, consumer spending, particularly on big-ticket postponable items like cars and so on and so forth. Well, if we're right this time, it isn't the Fed, it's the consumer, because the Fed obviously is going the other way. They're trying to do everything they can to stimulate the economy, even possibly QE2, another round of quantitative easing. So it would really be very different than any recession in the post-war period, and of course before that the data is a little sketchy. You're not quite sure, but very unique in that sense. And of course that's one of the reasons that there's so few of us who are predicting it, because almost everybody else says, well, as long as the Fed is this easy, there's no possible way you could have a recession.
Gary, you mentioned the housing market in your last comment. Could you give the listeners today what your forecast is for the U.S. housing market moving ahead?
Many people think the housing market is bottomed. Of course, they thought the same thing back in the summer of 2010 rather, when we had the tax credits for new homeowners. There was a spurt of activity. Prices rose very briefly. Everybody jumped in, wanted to buy houses for quick flips, but then they promptly reversed. The problem today is really very similar to back then. It's excess inventories. By our count, there are 2 million inventories over and above normal working levels out there, and excess inventories are the mortal enemy of prices. Now, I know a lot of areas they say, oh, they don't have enough houses to sell and so on. The big problem is the shadow inventories, the inventories of vacant houses that have been foreclosed but not yet sold, houses that people are not living in. They listed, they couldn't stomach the bids they got, they pulled them off the market, and I think that we're likely to see a further big decline in prices. Now, what will trigger it? Probably the renewed foreclosures, because all the big mortgage servicers, and there are 4 big banks and Ally, they got into this roto signing flap. They didn't prepare foreclosure documents properly. And while they were settling with the state attorneys general and the federal government, they held off on foreclosures. They had enough bad publicity. They settled, as you recall, for $25 billion. It's out of the way. I think they're going to go back to foreclosures. And foreclosed houses, according to the National Association of Realtors surveys, on average sell at a 19% discount to existing houses. So if you get a lot more foreclosed houses on the market, that's going to depress the overall prices, and it will take a 20% decline from here in median single-family house prices to bring them back to the long-term trend that goes back to 1890.
Wow. Gary, shifting gears and talking a bit about investing, given the state of the worldwide economy, how can the rally in the stock market indices this year be explained?
More aggressive buyers than sellers.
That's a great answer.
It's amazing what's going on. Because it's so counter to the deteriorating statistics here and abroad. And the only thing I can think of is this very odd behavior now of, oh, goody, it's so bad out there that we're going to get more stimulus from the Fed. and the other central banks. It's got to be so bad, then that makes it good. Well, if it's that bad, it's bad. I mean, if things are so bad that the Fed is going to step in with more buying of treasuries and mortgage-related securities, and that's what constitutes quantitative easing, then it's really bad. And that's what their minutes that were released recently from their meeting last month indicate. And so I think that there's been this expectation, the hope that every time things are bad enough, the central bank steps in, stimulates more, and that's good. But the history of this is, if you go through quantitative easing 1, QE2, Operation Twist, which was buying long securities, selling short securities by the central bank, each one of those has had less and less impact. And markets get callous, and they understand that there's no lasting impact. So the next one, maybe the rally, maybe it's buy the rumor, sell the news. Maybe by the time they announce it, we'll have completed whatever the effects is going to be on stocks and other risk-on trades. But I don't see any lasting impact, and I think that the economy is really so bad it's bad.
So, Gary, is your outlook for stocks, would you describe it as bearish?
Yeah, it is, because I think that sometime over the next over coming quarters, we're going to see 4 quarters in a row where we're going to see a Standard & Poor's operating earnings of $80. Now, the consensus for this year is over $100. The numbers have been cranked down, but they're still much higher than that. And if you had that, and I don't know which 4 quarters it's going to be, maybe the second half of this year and then first half of next year, but if you had that and you put at the bottom of what would obviously be a bear market reaction to that weakness, if you put a multiple of 10, a price-earnings ratio of 10, that's 800. And 800 is a long way from where we are now, which is a little above 1,400 on the S&P. And there are 3 reasons I would cite for those lower earnings. One is a global recession, and what that means is that the revenue growth, the top-line growth of corporations turns negative. The second thing is that U.S. companies have done a bang-up job of promoting productivity by cutting costs. They didn't have any top-line growth. Pricing power was non-existent, couldn't raise prices, but they did cut costs. Of course, that's why the labor markets have been so weak. But they've run out of that ability. Whether it's temporary or permanent, I don't know, but it seems to have run out. They're not getting that bang per buck. And the third reason, so in margins I don't think are going to improve from here and probably fall back. And the third reason is a stronger dollar I'm forecasting, and that means that the foreign earnings of multinationals and export earnings translate into fewer dollars for companies that keep their books in dollars. So those 3 factors are behind my forecast of considerable decline in S&P operating earnings to $80 a share.
Gary, you mentioned your forecast is for a stronger U.S. dollar. Does that mean the gold bulls have it wrong?
Well, I'm agnostic on gold. It's got too many pressures pushing it around for me to figure out. But the dollar, I think, is the safe haven. It's the we sort of have a collection of descriptions of the dollar. It isn't that we're doing anything all that right, but we're the best of a bad lot. We're the tallest midget. We're the slowest falling rock. We're the best horse in the glue factory, or one that a client of ours came up with. We're the valedictorian in summer remedial school. Yeah, I like that.
Oh, those are great. Now I forgot my next question. Let me ask you about Europe. We talked a little bit about Europe on a cursory basis. How do these sovereign debt issues play out? Does Germany just get sick of this, and do they throw in the towel, or does Greece say we're going back to the drachma and we're going to crank up the printing press?
Whatever they're going to call it. That's a question I don't think anybody, including the European leaders, knows the answer to. The problem is they combine the Teutonic North with the Club Med South under one currency, but no common fiscal policy, and that's probably not possible because you have such divergent economies and cultures. I mean, to get the Greeks to pay their taxes, work 8 hours a day, do all the things the Germans do, hey, that's not likely, at least in the next 1,000 years. So they've got a serious problem there, and they got a tiger by the tail, because if they let Greece leave or force Greece to leave because they don't knuckle under the austerity, And Greece is already, the Greek economy at the end of this year will be down about 20% from the peak. I mean, a horrendous decline, a real depression. But if Greek doesn't satisfy the Teutonic North, leaves, then the question is who's next? You get a run on the banks. The contagion comes into full flower. But of course, the alternative is to keep bailing them out. They're doing it now through the European Central Bank. And okay, that the bank supposedly has unlimited funds, but it really doesn't, because it's got a question of credibility. And the more debt piling up on the ECB's balance sheet, which is really in effect supporting indirectly the deficits of the weak countries, the more that piles up, the more people are going to say, hey, wait a minute, who's ultimately backing this? And it's the Germans. So you say, how much can the German balance sheet stand? We're watching the yields on the 10-year German Bund as an indicator of that, because if those yields start to jump up, maybe it's telling you that people are concluding that there's just too much load for even the German balance sheet to stand.
Would I infer from that comment, Gary, that you would expect that the euro in its current form at least changes significantly?
I really don't know. I mean, there's a strong desire to keep the whole Eurozone together, because it is the culmination of the decision after World War II by the French and the Germans to basically communicate in a different way than they had for the last couple hundred years, which is all-out war. I mean, it's literally true. The French and German leaders, de Gaulle and Adenauer, got together and said, we got to do something different here. And they said, well, if we can intertwine these economies, then the odds of military conflict go down demonstrably. It's been a grand experiment, and of course nobody wants to throw in the towel on that, much less face the chaos of disillusionment. And of course the idea is that one country leaves, this is the decision Lincoln made. Lincoln said, I'm going to keep this union together at all costs, and it was a huge cost, but boy, are we all lucky he did. If they let somebody go, then the question is, anybody can go, and the whole thing really has no continuity. So there's tremendous pressure to try to keep it together, but clearly it's not viable, and I just don't see anything. I think that the euro, I mean, in our portfolios, we're short the euro currency, and I think it's going to parity one to one. And of course, it's been weak. It's been weak lately, but you're 125, and I think you're probably going to 1 to 1.
Well, Gary, thanks so much for joining us today. We very much appreciated your time, and hope you'll come back sometime.
I hope so, too.
All right, this is the Everything Financial Radio Show on the Legacy Radio Network. We will return after these words.